At Nedgroup Investments Cash Solutions, we believe that idle cash is a missed opportunity. We manage in excess of 140 billion rand in cash by providing money market fund solutions to a large client base. Our range of solutions include convenient and efficient money market and enhanced money market funds. Transacting is simple and easy and can be done either online or via our dedicated cash desk. There are no transacting costs, no minimum balances, and no entry fees. There are 3 main features that make our funds the most efficient solution for your cash. Money market funds are the lowest risk unit trusts and are highly regulated. Furthermore, these funds provide diversified credit risk across a range of banks and other credible issuers. Money market funds consistently offer better yields than call accounts and are often better than longer-dated fixed deposits. There is no compromise on liquidity with either same-day access for money market funds or next-day access for enhanced money market funds. Achieve the yields of a fixed deposit but with the access of a call account. Cash Solutions is the perfect place to park your surplus cash. Visit www.netgroupinvestments.co.za today for more information. Nedgroup Investments. See money differently.
Well, I think South Africa is quite fortunate in the fact that we do have a banking and financial sector that works. We have proven our resilience and we've been tested in many crises. Joining us now, we will have with us a portfolio manager from Taquanta Asset Managers, and that is Sharika Salie. She joins us today to share a bit of insights with us. Sharika, thank you so much for being with us this morning. I was having a look at what your presentation is titled, and that is A Relatively Unscathed Financial Sector. What the difference is about the latest, the latest crisis that we're currently facing versus where we were during the global financial crisis. You've got all the answers, so I'm going to leave it up to you. So do take it away.
Thank you, Tumi, for the introduction. So without further ado, let's get started. Okay, so the first slide over here that I have is the implied SA equity market volatility index, also known as the VIX index. So basically, what this chart is showing is that, equity market volatility during the 2020 COVID crisis initially reacted, strongly and quickly to the news of, lockdowns and the effect that would have on unemployment or employment levels, and also the complete and total seizure of economic activity. So at that particular time, you can see from this volatility index, there was a lot of fear in the market. There was a lot of uncertainty in the market. This is something, that the South African market has never seen before. So as you can see, a lot of volatility in the market, a lot of fear in the market, massive sell-offs in the equity market and massive sell-offs in the bond market, and a lot of fear in the money market. Okay, so this next slide over here, we're going to take a look at, the evolution of spreads throughout the crisis. So you can see here in the red line, we have financial senior 5-year issue spreads. In the maroon line, we have financial subordinated 5-year debt issue spreads. Then we have in blue the corporate sector, and in green we have the SOE sector. So, this is the slide that really got me interested in, what exactly happened, because I was quite shocked when I saw that spreads did not blow out much more than what it did in 2020, especially considering that in April 2020, the IMF came out, saying that this is the worst economic crisis since the Great Depression. But then I looked at this chart, and you can see what happened in the global financial crisis. Look what happened to financial senior spreads. Look at that massive uptick, and look how long spreads were high for. But then you see the small little bump. It looked like a little speed bump there, a little speed bump in March and April of last year, for something that was classified as the worst economic crisis since the Great Depression of the 1930s. Spreads did not blow out the way it was expected to blow out. So obviously there was interventions that was happening in the background, and basically the gist of this conversation is to see, what were those measures that stopped spreads from blowing out to the extent that it blew out in the global financial crisis. So let's now take a look at, at the prevailing environment. So in the prevailing environment, we're going to look at, the interest rate, we're going to look at inflation, and we're going to look at the next slide, which will show you, the GDP growth. So you can see going into the global financial crisis, you can see SA was coming out of a massive commodities boom. So inflation was very high. You can see the SARB was struggling to get inflation within the target range. What's also interesting to note is that in the years prior to 2008, South Africa's economy was growing at over 5%. That is phenomenal growth, especially in light of the current environment, in 2020, 2019, 2018, what the SARB was playing with was an environment of very low inflation, subdued inflation, and it wasn't even demand pull inflation, this was cost push inflation. So our economy was very weak. Also, in the next chart I'll show you, if you look at the growth of the economy, going into the global financial crisis, our economy really was not growing. I mean, look at that range, 0% to 1.4%. I mean, that is exceptionally low growth. So you can see inflation obviously was not a massive concern for the SARB, and this really was an environment that gave them room to decrease rates in the way that they did, which I'll chat to later. And you can see going into the COVID crisis, around about the 1st of Jan 2020, we had a repo rate that was sitting at 6.5 with low inflation. So we were fortunate enough, we were sitting with a nice fat real interest rate, and it really did give the SARB room to do what they did. Okay, and I thought this is an interesting chart to add. A lot of portfolio managers, we look at the market, we look at the data, but sometimes, we don't really see the effect, talk about actually the effect that regulation has on a market. So over here, you can see prior to the global financial crisis, securitizations, which is, that red bar, you can see securitizations was actually the biggest issuer in the debt capital markets, and then because of Basel III that came in post the global financial crisis, because the governments were busy bailing out the banks overseas using taxpayers' money, they put in strict regulations, and these banks had to obviously manage themselves more prudently, and they put in quite a lot of regulation when it came to securitizations. And this just shows you the effect that regulation has on a sector. So securitizations went from one of the biggest issuing sectors on the JSE to now, if you look there at the red little dot on the right hand side, you can see it's negligible. They issue a very little amount of debt on the JSE, and that also has to do with the fact that securitizations became a very like taboo word after the global financial crisis. But that said, it's sustainably low because regulation made securitizations very expensive for the banks. So this used to be a very profitable vehicle for the banks, but now obviously because of the regulation, etc., this was no longer became a profitable sector for banks to issue out of. Next, we look at the Basel III capital adequacy of the big four banks. So we can see here, even coming out of the global financial crisis, unlike the banks offshore, South Africa has a history, our banks have a history of being well capitalized, and I'm just talking now about the big four, okay? They have a history of being well capitalized. So you can see Basel III, in terms of capital, it wasn't really much of a massive shift for the South African banks. And unlike overseas, where governments had to bail banks out, that was not the case in South Africa. And if we look here, Basel III had what it did do in South Africa is it had a permanent effect on our spreads. So prior to the global financial crisis, you can get this data off Bloomberg, but Bloomberg only has this data from 2010 onwards. If you want data, I had to go to the banks, I had to ask them to look on their systems to see, what the issue spreads were prior to 2010, and I thought this was quite fascinating. So prior to 2000 and the global financial crisis, the older information you see from 2007 to about 2008, banks did not differentiate between term funding. So a 3-year NCD was priced the same as a 5-year NCD, and even at certain points in the months in that period of time, they didn't even differentiate between 1-year, 3-year and 5-year funding. So what Basel III did, it made long-term funding much more valuable to the banks. And as you can see there, as markets always do, when there's new regulation, it like kind of overacted. So you can see there the difference between a 1-year spread on the right hand side and a 3-year spread was something like about 60 basis points. But now on the far right hand side chart, you can see things have normalized a bit. So now, you know, in the last couple of years, the difference between 1-year, 3-year and 5 years, something like anywhere between 10 and 20 basis points. Okay, now we're going to look at the SARB's mandates and its tools. So what's interesting is the mandate of the SARB is protected and it's enshrined in the South African Constitution. And it says, in the Constitution, the SARB's mandate is to protect the value of the currency in the interest of balanced and sustainable economic growth. Now let's look at that term, the protect the value of the currency, protecting the purchasing power. So that means, you know, keeping a low and stable inflation rate, hence the adoption of inflation targeting. As you know, the SARB's inflation targeting range is between 3 and 6%. It's important to note there, in bold, a stable banking sector is fundamental to the efficient implementation of monetary policy and broad-based price stability. So you can see why big banks are systemically important to the entire system. They are the way that the SARB pushes, you know, the how can I say, the policies into the real economy. So the SARB has 2 tools that they can use, you know. They have monetary policy tools, i.e. just in layman's terms, just the interest rate, and then they have regulatory tools. So in the global financial crisis, okay, the SARB used one of that tools. They used monetary policy tools. So in that crisis, they just reduced the repo rate. But what's nice about here is that they really went above and beyond. They used all tools in their how can I say, their war chests, you know, for lack of a better word, to mitigate the fear and the liquidity squeeze that was felt in the market on the onset of the crisis. So let's just have a look here at some of the interventions that they did. So number 1, they significantly reduced the repo rate. Going into the crisis, the repo rate was at 650. And then within a span of 7 months, which is a very short window, they almost halved that repo rate to 3.5. So that over there was a drastic measure, and it was done in a very short window. And then 2, they made additional liquidity available to the banking sector. So, you know, they increased the size of repo facilities, they increased the duration of repo facilities, and they were implementing, you know, bond buyback. So if you had a SA Govie bond and you needed some liquidity, you could sell it back to the SARB and you'd get cash, you know. So they provided a lot of relief in terms of liquidity to the sector. And they also partnered with banks and National Treasury to implement a loan guarantee scheme for small and medium-sized enterprises. So, you know, like if you a business were with a turnover of less than 300 million, you know, they could apply for a guaranteed loan, and with this cash, they could use it to pay expenses. So they could pay, you know, like the rent, you can pay your salaries, you could pay your suppliers. So that, you know, provided like a lot of liquidity to the system and support, you know, support to businesses that were experiencing distress due to this lockdown. And then also the SARB's Prudential Authority. So the Prudential Authority is like a division within the Reserve Bank, and they massively assisted by providing capital relief to the banks. So as you know, banks need to hold capital against risk-weighted assets. So the capital relief was in the form of, you know, like, so if a bank had a loan, okay, if that was in good standing prior to the COVID crisis, and that loan became impaired because of the COVID lockdowns and the crisis period, then they said, if the SARB said, if the loan is in good standing prior to the COVID crisis, the banks do not have to hold now additional capital against that impaired loan. They also lowered the capital requirements. So, interestingly there, ABSA and Nedbank's capital requirements was reduced from 12.5% to 9%, and FirstRand's capital requirements was reduced from 13% to 9.5%. And all of this was to ensure the continued smooth functioning of the financial markets. Also, the liquidity coverage ratio. So there, what banks have to do is, they anticipate outflows. So for the outflows that they anticipate, they need to hold liquid assets against those anticipated flows. So what they should do, what banks do, is they hold 100% of liquid assets against anticipated flows. So here the SARB said, okay, we're going to lower that LCR ratio. You now only have to hold 80% instead of 100%. And besides all of this, I think the SARB really went the extra mile, because they also started issuing, like directives and guidance, to the financial sector in this period. One of the things that they did specifically to the banking sector, they said, okay, they issued a directive to say, please, don't, they would like you to refrain from paying out dividends and bonuses, etc. And, they asked the sector not to engage in share buybacks, because they said, please keep that capital for the real economy, and keep that capital in case you need to absorb losses. They also, also gave some, IFRS 9 guidelines. Even though they're not an accounting body, they still went that extra mile to, give a lot of guidance to the market. And lastly, now we look at the effect of the actions in the money market. As you can see here, instead of spreads blowing out, to levels last seen, like we saw in the global financial crisis, massive blowout in spreads and a prolonged blowout in spreads, the increase in spreads was very much muted. And if you look on the right hand side of the chart, you can see spreads went even lower, but I don't believe that has anything to do with the SARB's actions. That was what Ian and Sean were talking about earlier, about the massive amount of cash that came flooding into the money market system. And and because of that, it ended up driving rates lower, but I'm not going to touch on that. That is like a discussion for another time. So thank you very much.
Sharika, thank you so much. That was very comprehensive. I've got maybe one or two questions for you, but I think because you had so much to cover, take a sip of water and catch a break. I'm going to just try and summarize some of the key points that came through from your presentation while we do that. I think one of the things that came out for me was that obviously South Africa has a history of being well capitalized. Obviously, that is something that we've already said at the onset, that we've been very fortunate in that we've been quite resilient, and we've been able to to weather the storms in many of these crises. In terms of the second point, and you've said that you had it up on your presentation very much in bold, and I'm going to just basically say this verbatim, that a stable banking sector is fundamental to the efficient implementation of monetary policy and broad-based price stability, hence inflation targeting, etc. And then, of course, another important point that you made there was the interventions that the South African Reserve Bank embarked on, which actually feeds in very nicely into our next speaker, who will be joining us from the South African Reserve Bank, but more on that a little bit later. I think what has been interesting about those interventions was that the South African Reserve Bank was not acting as a silo. We did have collaboration and partnering with other banks, the National Treasury. So, for example, the and the loan guarantee scheme for small and medium businesses being one of them. So, just those were just some of the key takeaways that we saw from your presentation. Now that you've had the chance to, catch your breath after going through that marathon, there was just a specific slide that you brought up, and I'd like you to maybe talk us through it, because it's been interesting when I think about capital requirements for banks. Incorrectly so, I was under the assumption that, of course, maybe then banks should all have the same rules. But if I looked there, it seemed that ABSA and Nedbank needed to hold lower capital, where FirstRand and Standard Bank needed to hold higher amounts of capital.
Yeah.
Why is that?
Okay, so to answer that question, we look, at the calculation of the bank's capital adequacy. So, simply put, ABSA and Nedbank are smaller banks than FirstRand and Standard Bank. So they are considered in the capital calculation less systemically important. So the bigger you are, the more systemically important you are, because you have the ability to, you are bigger and you have the ability to disrupt more than a smaller bank. Therefore, you have to hold more capital, and there is like a systemic risk component in a bank's capital calculation. So because of the size of the FirstRand and Standard Bank, they have to hold a bit more capital than Nedbank and ABSA.
I'm so glad you cleared that up for us, because as I said, this can be quite misinterpreted, because you might think because they've got lower capital adequacy requirements, maybe they're not as well capitalized, or maybe they're not as good of a bank.
Yes, 100%.
Another point that you made there was with regards to spreads. Do you think they've just come down too much?
Yes, the simple answer is yes. I think spreads have come down too much. You can see, there was a time that spreads were lower, much lower than they were in pre-COVID levels, and that just shows the power of that demand and supply imbalance. You had asset managers like desperate for assets. I remember, just managing, NGI's funds. The first 2 weeks of September, 15 billion coming in. What do you do with that money? So you go out into the market and you kind of like forced to buy these assets at like ridiculous levels, which we did not do. We opted to do some other things, which we can also chat about. Ian can take you guys through what Taquanta did, but basically there was these assets that were at very low spreads because banks were sitting on loads of cash and there was no lending happening in the economy. So, in simple terms of the bank, what they do is they borrow money from the debt capital markets, and in turn they lend it out to the man on the street or to corporates. But because there was no lending happening in the economy and they were sitting on so much cash, there was no reason for them to issue debt. So, and that was reflected in the spreads. And since then, spreads have ticked up slightly, but they're still at levels prior to the COVID crisis. And you must understand, we're still in a uncertain environment. Corporates' earnings are coming under pressure, banks' earnings are coming under pressure. There could be a third wave. So no, I do not believe that spreads at the moment are indicative of the risks that people are taking.
I'm really interested in knowing what Taquanta did at that particular time. Hopefully we might be able to sneak in an answer to that. But I'd also like to get your views on the inflation and interest rate outlook. And obviously this is key to what you do, but how are you reading the current situation? Are we going to be following suit with what we're seeing in global banks, lower for longer in terms of interest rates based on the inflation outlook?
So at the moment, there is no room for the SARB to cut, given that the SARB is forward-looking. So, any rate move now will affect inflation in 18 to 24 months' time. And also, the rate cuts that the SARB did, it still has not been fully felt throughout the economy. As I said, the effects of a rate cut, it lags. There's a lag. So I don't believe there is room to cut at the moment, and as a result, I think that we are going to see inflation contained. Inflation is well contained. There is no there is some pressure on it at the moment, but it will be relatively contained. So what we believe, that in terms of our outlook for interest rates, we don't think there is going to be a move this year, but definitely next year in 2022, we do think that spreads are going to tick up.
Sharika, just on a final point, we do have the Deputy Governor of the South African Reserve Bank who will be joining us shortly. He's our next speaker in the next segment, and I think everybody's always interested what the thinking behind the South African Reserve Bank is, or going behind the scenes, trying to understand what it's like from a policy maker. Being a portfolio manager in this very unprecedented time, just maybe your personal view. You mentioned that there were some things that Taquanta did, but I suppose maybe you as yourself as being a portfolio manager, what was it really like trying to navigate these, this uncharted territory?
Yeah, it was very hard. As you know, we are big supporters of the banks. The banks issue NCDs. It's exceptionally liquid instruments. I mean, I can give you, in March 2020, the only instrument that you could sell was a vanilla bank NCD, and we had brokers sending massive lists of assets for sale. So you'd see bank senior unsecured paper, you'd see massive corporate amounts of paper for sale, your securitizations, various paper. Those things were not selling. Every single week the broker's list was getting longer and longer and longer. So the only thing that you could sell in March and most of April 2020 was a vanilla bank NCD, and that's why we like NCDs. It's very liquid and it's very easy to sell, and you can sell it in large quantities. So you could sell, I recall some month ends I would sell something like 3 billion of NCDs back to a bank very easily. Yeah. And and not make a loss. So the pricing is transparent on NCDs, and that's why we like it.
Sharika, thank you so much for joining us this morning and sharing your insights with us. That was Sharika Salie. Of course, she is a portfolio manager at Taquanta Asset Managers.